Okay, let's jump right into it. Welcome to today's explainer. Look, if you've spent even 5 minutes on financial social media lately, you know you've been absolutely bombarded by the hype. Every other ad is some fake trading guru promising that their brand new AI bot has miraculously cracked the stock market code, right? They're telling you that you can get rich quick while you sleep. Well, today, we're putting our researcher hats firmly on, and we are aggressively stripping all of that noise away. We're conducting a rigorous, no-nonsense audit of multi-agent LLM training. We want authentic, cold, hard methodology. We want to see what actually happens when you force AI to trade, measure it objectively, and, this is the key part, absolutely refuse to hide the losses. 78%? I mean, wow. If someone online told you their trading bot won 78% of its trades, you'd probably hand them your wallet immediately, right? It's an incredibly seductive number. And the crazy thing is, in the previous phase of this research, a project called the Polybot series, the fleet of trading strategies actually hit that massive 78% win rate. But here is the brutal asymmetry of the market. Despite winning 4 out of every 5 trades, the system still lost roughly 33% of its total bankroll. So how is that mathematically possible? Well, because the one single loss it took was catastrophic enough to wipe out all 4 wins combined. It's literally the equivalent of picking up pennies in front of a steamroller. You win consistently, right up until you get totally crushed. It's the ultimate trap in algorithmic trading, and it's exactly how retail traders get fooled by those really impressive-sounding win rates. So here's our roadmap for today's rigorous audit. We'll cover 1. The parametric trading trap. 2. A new research question. 3. Inside the LLM committee. 4. The infrastructure of honesty. And 5. Surviving the fresh sample. Let's get into it. Section 1. The parametric trading trap. Let's look at exactly why those previous bots failed. That first phase of the Forza research focused purely on what we call parametric strategies. These are explicit, heavily rule-bound systems. You can think of them as strict, hard-coded instructions, like if the price hits exactly X, buy, or if the volume drops below Y, sell with these specific caps. Researchers spend months tweaking and hand-tuning these parameters to absolute perfection. But mechanical rules like this almost always create a complete illusion of an edge. Why? Think of it like a student memorizing the exact answers to a specific practice test. They look like an absolute genius while they're practicing, but as we know, the real market isn't a practice test. When the real exam comes and the questions change even slightly, that student fails completely. Once you measure these rigid strategies honestly, in real time, those mechanical artifacts vanish, and the strategy just bleeds money. And this brings us to a foundational insight from the lead researcher on the project, Thorsten Meyer AI. Quote, "The honest research finding wasn't on the winning side. It was on the losing side. A parametric trading strategy that looks compelling in a backtest will, almost always, fail to survive a fresh sample." You know, in quantitative finance, admitting your bot failed isn't a sign of weakness. It's a badge of honor. Actually, scratch that. It's the absolute only way to survive. Hiding your losses or making up excuses for a failed model is a one-way ticket to blowing up a real-world portfolio. Rigorous, unforgiving testing is literally the only safeguard we have. Moving on to Section 2, a new research question. We are shifting gears to test multi-agent LLM judgment. Now, let's clear the air and be incredibly precise about what we are actually trying to do here. We are not asking, can an LLM predict the market? Predicting the market like some omniscient oracle is impossible. If someone sells you a crystal ball, grab your money and run. The honest prior assumption for market prediction is always no. Instead, the researchers formulated a highly testable question. Can a committee of AI agents, structured into specialized roles that actively debate each other, make a decision that is at least marginally better than a coin flip? We're moving entirely away from the impossible dream of prediction and focusing strictly on structured adversarial decision-making. Section 3, Inside the LLM Committee. Let's pop the hood on this 13-agent architecture. To understand this architecture, which is pulled from the open-source Toric Research LangGraph project, you kind of have to stop thinking of it as just a single piece of software. Instead, picture a ruthless, high-stakes corporate boardroom. It is a living, breathing debate designed to enforce extreme discipline. Step 1 unleashes 4 specialized analysts to independently dig up every single clue they can find. Then, in step 2, the data goes to 2 researchers tasked with a brutal bull versus bear debate, actively throwing down arguments while a manager arbitrates. Step 3 introduces a highly paranoid 3-voice risk team. They are aggressive, conservative, and neutral. They essentially act as the brakes, forcing everyone to explicitly articulate the downside risk. Finally, step 4 is a 2-layer decision where a specialized trader proposes an action, and the ultimate portfolio manager has the supreme power to either veto or execute. Let's flesh out those 4 analysts who kick the whole shebang off. They're working in parallel but with wildly different jobs. You've got the suit, poring over dry 10K balance sheets and earnings reports. You've got the detective, scraping news flow and tracking what the corporate insiders are quietly buying or selling. You've got the market structure geek, looking purely at the mechanics of the trade. And finally, you have the poor, exhausted agent whose sole job is to subject itself to the absolute chaos of Reddit and X just to gauge social media sentiment. They gather these incredibly distinct worldviews before the boardroom doors even lock. So why does this convoluted setup actually matter to your wallet? Well, it comes down to one brilliant design choice: the portfolio manager never actually sees the raw data. They're entirely walled off from the massive dumps of text the analysts find. They only receive the synthesized arguments from the committee. This prevents the AI from just blindly guessing or hallucinating a stock price based on random noise in its context window. The system physically cannot just say buy. It is structurally forced to prove its math, defend its logic, and explicitly reason its way to a conclusion. Section 4. The infrastructure of honesty. Let's look at the Forza fork additions. A raw multi-agent graph, like the one we just discussed, is fascinating for sure, but on its own, it's kind of just a neat tech demo. It completely lacks the heavy operational machinery needed for real quantitative testing. And that's where the Forza fork enters the chat. This upgrade transforms open source code into a true research instrument. It wires in an autonomous loop for daily scheduling, adds MCP plugins to give the AI access to heavyweight financial tools like FactSet, and builds a local dashboard so your proprietary data doesn't leak to the cloud. But the real star of the show here is the append-only audit log. Why is this absolutely crucial for model-based trading? Because human nature makes us want to intervene. When a bot makes a terribly embarrassing trade, human operators have an overwhelming urge to quietly delete it and pretend it never happened, just to make the AI look smarter. Append-only logs force brutal, inescapable honesty. Every decision, good or disastrous, is permanently recorded. Now, the absolute nightmare scenario for any retail trader experimenting with AI is the bot going rogue and draining a real, hard-earned bank account in seconds. That's exactly why hard-coded safety mechanisms are what separate a serious research tool from a reckless retail gimmick. The system defaults to simulated paper trading. Even if it wanted to, the live brokerage endpoints are hard refused at multiple architectural layers. You physically cannot accidentally trade real money without going in and manually overriding the code in several places. Plus, everything generated is stamped with honest by design metadata. This ensures that when the system inevitably loses its fake money, the operational journal makes it totally impossible to hide. Section 5. Surviving the fresh sample. This is the ultimate empirical test. To truly grasp algorithmic trading, you absolutely must understand the difference between in-sample and out-of-sample data. Think of in-sample data as an open book quiz where you already hold the answer key. This is the historical data you use to build and tweak your system. Performance here means absolutely nothing. It's trivially inflatable, you're just curve-fitting your bot perfectly to past events that will literally never happen the exact same way again. Out-of-sample data, however, is walking into a pop quiz completely blind. It is fresh, unseen, real-time data. This is the truth. If your backtest looks like a beautiful upward chart, but the bot immediately bleeds cash in the out-of-sample window, you don't actually have a trading edge. You just have a math illusion. Failing to respect this difference is exactly how billions of dollars are lost on Wall Street every single year. The author puts it perfectly, delivering a stern warning to anyone playing in the space. A high win rate over a small sample is not edge. A small alpha versus benchmark over an in-sample period is not edge. Edge is what survives a fresh, out-of-sample window with the same configuration. I really want to pause and hammer this home for a second. As of this recording, absolutely nothing in the retail AI market has survived this test yet. Not one. You should remain highly, highly skeptical of anyone claiming otherwise. The researchers behind this very project know full well that their impressive 13-agent committee might completely fail this honest test too. So we're left with the ultimate, simulated, paper money question. Will this 13-agent committee actually beat a coin flip after fees once the fresh, out-of-sample data starts rolling in? The researchers are letting the autonomous loop run untouched for a few weeks to gather real truth. No hype, no manually rescuing the thesis if the bot makes a dumb trade, just pure, honest data. So, what do you think? In a market built fundamentally on human greed, fear, and pure chaos, can a boardroom of 13 debating AIs actually find a real mathematical edge? Or is it just a highly sophisticated, incredibly smart way to lose money? I cannot wait to see those week 3 results. Thanks for joining me on this explainer, and remember, keep questioning the data.